Welcome back to part 3 of our income statement balance sheet exercise. What I've done to kick us off is I've taken my data from year 1, all the income statement and balance sheet data, and I've copied it and pasted it into this next column here that I've called year 1 scenarios. So copy and paste it, and I had to fix a few things because there were some references to percentages that we put over here on the side, and when we copied and pasted these, it didn't all work nicely. So I've tidied this up a little bit. For example, you will see here that my gross profit percentage refers to some data that I've put down the bottom. So for example, the gross profit data I've put here, and the tax rates and the dividends. I've copied all this data across as well. This was our credit sales and debtor days information and so on. Stock days, cash information was here. So now that I've tidied it up and set it up nicely, my income statement works really nicely. So we can go and test a few things. We can see what is the impact of doing some things a little bit differently. So we can start off by saying, what if we are able to increase our gross profit margin to, let's kind of really stretch it here, not that we're likely to do this, but what if we made this 80%? All right. Now the idea is you can compare the year 1 as we originally had the data to this scenario, and you can see, well, obviously if your gross profit is 80%, your cost of sales is going to be the 20%. That's the other part of the 100%. And then we're going to reduce our profit by paying away expenses, and you're going to see here, interesting that the interest expense is so much lower. So what's happened is that ultimately we've made more profits, we've paid more dividends, we've retained more equity. And if you've retained more equity to the balance sheet, well, then you'll need less debt in order to fund the operation. So the more profits you make, the less debt requirement in order to fund the operations, assuming nothing has changed. All right, so that's quite an obvious one. And then when we come down to the bottom half of the balance sheet, what's changed here? Well, certainly the assets haven't, because there's no change in the depreciation policy. The debtors haven't changed because it's the same amount of sales. It's customers taking 90 days to pay. The cash hasn't changed because that's a percentage of sales. But the inventory has changed now. Because we changed the gross profit margin, it means the cost of sales is less. And based on a lower cost of sales, the inventory number is going to be less. And likewise for the creditors, if you're buying less from your suppliers, you're going to get less on credit from them. All right. Let me check my tax number here. So based on the taxes, we're paying more taxes because we've made more profits. So when you get to the end of the year, the portion outstanding is going to be higher. That makes sense. Okay, so all we did was we changed the gross profit, and we looked at the knock-on effect from doing that. Let's move that back to 50%. That's one scenario we can test. Let's test another scenario where we say, what if we take our customers here and say, what if we can get them to pay on 30 days? What are the implications of our customers paying us sooner? So if we think this through, it means we're going to get the money faster from our customers. And if we're going to get the money faster, we should have more cash on hand. But because we've forced our cash to be 5% of sales, the way this is going to show up is ultimately we're going to need less debt to fund the business. Because if we get to the end of the year and our customers owe us 2.2 million, the only way we can fund that is to borrow the money from the bank in the interim while we wait for our customers to pay us. So let's test this. Let's go and say 90 days, make it 30 days. And you'll see here that the debtors number comes down dramatically. We saw some signs of this, I think, in the first part of this video series where I did show you some adjustments on this. So if your customers pay you sooner, you're going to have less outstanding in debtors, and therefore you're going to have a lower amount of debt required in order to fund the business. All right. The other thing to look out here is that if you've got less debt and if you've got less debtors, you're going to have a lower capital requirement. We know about that, and therefore less money invested in the operations. Okay, so that's a good sign. Let's at the same time come here to our stock days and say, what if we could get our stock days down to, I don't know, 25 days? What will happen? All right, so you'll see that the inventory number will reduce. If you've got less inventory, you've got less cash tied up in the inventory. Now again, because our cash is a fixed number based on our sales, the number is not going to change there, but it's going to reduce, it's going to further reduce our debt requirement. You might want to look at this debt as a negative cash if you want, and just showing that if you reduce your inventories, it's going to have more cash, and therefore you can reduce your debt funding. All right. Now, the creditor funding is working in our favor. Remember, this is money that we owe our suppliers, and at the moment we take 60 days to pay our suppliers. Now, what if we were able to negotiate with our suppliers that we pay them after 3 months? It's going to be very hard to do, but let's, for the sake of this exercise, make that number 90 days. Our creditors is going to go up because now we owe our suppliers more. And if our creditors is going up, this is a source of funding that we can use this money to further reduce the amount of debt required in the business. So this is the grand old example of Raymond Ackerman and Pick n Pay. Those of you who are familiar with Pick n Pay, is that the business funded its growth in the 1980s by paying its suppliers on 90 days. It's like taking a loan from your suppliers for 1.2 million rand to put stock on the shelf in your business and only pay them once your customers have paid you. Remember, creditor funding is free. It doesn't have an interest rate attached to it, whereas debt funding has interest attached to it. So if we can reduce the debt funding because we're using funding from our suppliers, by implication, your interest expense is lower. You are making profit by virtue of borrowing the money from your suppliers instead of borrowing it from the bank. So the scenario analysis helps us show how these things reveal themselves. Okay, let's do a few performance calculations. Okay, so some key performance calculations. Return on equity is the number one performance calculation that our shareholders are interested in. And the formula that we use here is to take the profit after tax. In fact, I call it profit after tax. That comes naturally to me, but these days it's earnings after tax. And we're going to divide that by the amount of equity on the balance sheet. So let's simply put equity here. And then we're going to multiply this by 100 because we want to get a percentage. Let's make that cell a little bit wider. So that's the formula we're going to apply. Let's go and do this calculation for the first year. Okay, equals, let's head on up and find the information we need. Here's the earnings after tax. That money belongs to the shareholder, no one else. Doesn't have any other obligations attached to it. So we're going to divide that by the amount of money invested by the shareholder. Strictly speaking, we should use an average equity over the last 2 years. That is a more accurate way of doing it. But I don't have a previous year in this example, so I'm just going to short circuit this and just use this number. All right. And there we've got an answer. We want to convert that to a percentage, and 18% is what the shareholders are getting as return, and that's okay. That represents the long-term average if you had invested your money in the all share index on the JSE. So not a bad return. Okay, let's see what is this number in our adjusted scenarios. So if we copy and paste that over, let me make this a little bit bigger. Let me use some formatting here so we can see, and we'll add a couple of decimal places. All right, so 20%, and we want to work out. I mean, I'm interested to know, oh wow, why is it higher? What's different? We'll come back to that. We'll work that out in a moment. We'll see what's changed. And then let's see what happened in year 2. All right, so that went down in year 2. So clearly our scenarios here, whatever we did, helped improve the performance of the business. And I want to find out what I did to help improve the performance. So I'm not going to go into the theory behind this, but there are 3 drivers to return on equity. If we know the profit after tax, I'm going to call this PA percentage. If we know what the profit after tax percentage is, and if we know what the activity of the business is, you could think of this as the efficiency. I haven't spelled that right. Activity is a form of efficiency. I'll show you how we calculate that in a moment. And if we calculate the leverage, which is the amount of debt in the business, let's push these off over to the right hand side here. So these are 3 important ratios, if you want, that we can use in order to uncover what's happening in this business. So profit after tax, let's put the formula in here. Simply going to take the earnings after tax, we're going to divide it by the sales, and we're going to multiply this by 100, and that will give us a profitability percentage. Okay, let's go and do that. Equals income statement, earnings after tax, divided by the sales. So we're just getting a proportion of what's left over, and we're going to convert that to a percentage and add a decimal place. There we go, 12.6%. Great. And why don't we copy and paste that all the way across and see what happens across all the years. So clearly here, the profit after tax from one year to the next has gone up. Okay, that's going to be a key driver of why our return on equity went up. But it's not all the information. We need to go and find out the activity here. So activity is a terminology that I give to a business to imply that you want to have lots of activity going on. But the formula that we're actually doing here is called the net asset turnover rate. And net asset turnover rate is a function of taking the sales and dividing it by the net assets in the balance sheet. It's as simple as that. Sales over net assets. And what we're doing here is we're measuring the business's ability to generate sales. Here we go, generate sales based on the amount of assets used in the operations. Okay, so let's get a number here. Take the sales, 10 million, divided by the net assets. Sales in relation to net assets. So we've got a number here that's a fraction bigger than 1. And what that says is if this number was 1, then we would have generated exactly the same amount of net assets that the business has. All right, so if that number was 1, then our sales would have been 9.4 million. But we did a little bit more than 9.4. We did 10 million. So that's why it's slightly higher. All right, we want this number to be as high as possible. You want to generate as much sales as you can with as little net assets as possible. So let's copy and paste this across all the years and see what happens here in the scenario or the year 1 scenario. This has improved substantially. Why has it improved? Look, our net assets is so much lower. And why are our net assets lower? Because our customers are paying us sooner and our inventory is less, and what we owe our suppliers is higher. So we've got a more efficient balance sheet here. Therefore, we've got less net assets, we've got less capital, and we've got less debt. So this is a more efficient business. Cool. Let's look at leverage. So leverage here is effectively how much debt you have in the business. And when I look at leverage, I'm only looking at the capital structure. I'm not interested in overdraft. I'm not interested in money we owe our suppliers. I'm only interested in long-term interest-bearing debt and how that drives the leverage number. So leverage is actually a function of taking the total equity, sorry, let me restate that, by taking the total capital, TC, and dividing it by the amount of equity in the balance sheet. A little bit obscure, I know that, but let me show you what this does. Let's go and get the formula and do the calculation. If I take this total capital number and I divide it by the total equity number, what it's going to reveal to me is the proportion of debt, the piece here that's involved in the total capital, but I've left it out of the calculation. So we're going to get a number here that is 1 point something. Let's convert that down to something that's a little bit more user-friendly. 1.35. Let's test this. If the debt was 0, then the total capital and the equity would be the same number, and therefore the leverage would be 1. In other words, 0 debt. Okay, so the fact that this number is higher than 1 implies that there is debt funding in the business. Let's copy and paste this right, and you'll see what's happened here is this number has come way down, very close to 1, and from this you can assume that the proportion of debt has declined. Let's see if that's true. Well, you can very clearly see it there. It's way less. Okay, so let's try a little bit of mathematical gymnastics here. We did a calculation where we used this formula, earnings after tax over equity times 100, and it gave us a return on equity number. I said to you, take it on trust that these are the 3 important drivers of return on equity. I'm going to do a calculation here that goes as follows. Take the profitability, multiply it by the activity, multiply it by the leverage, and let's see what answer we get here. Convert it to a percentage, add a decimal place or 2, and as if by magic, by combining those 3 ratios, we get to exactly the same return on equity. This is what's called a DuPont deconstruction. Now, I didn't take you through the maths of doing the deconstruction. That's not important. You can find that in my lecture notes, and I've got a slide where I take you through the maths. What I'm showing you here is that if you use these 3 components, you can get to the same answer as if you use the short number or the short formula. So now we can look at this and say, wow, what's going on here? Let's insert a few shapes here so we can see what's happening. So I'm going to use a little up arrow there. There we go. Profitability has increased. That's going to be good for my return on equity. The activity has also increased. Okay, so I'm going to copy and paste that arrow. I'm going to pop it over there. That's also going to help improve my return on equity. However, this debt component has in fact gone down. So let's turn this arrow the other way around and put it over there. Now, this is unusual sometimes because, well, let me not say this is unusual. Let me say this is a bit counterintuitive. You would think debt going down would help, and it does, because it reduces the interest expense, which means there's more profitability. But by reducing the debt, it means there's often more equity in the business, which hurts the return on equity calculation. So when we look at these different dynamics, it turns out that the improved activity and the declining leverage cancel each other out. You can see even here the proportions are very close. But the increasing profitability, therefore, is the remaining factor that's driving the increased returns to shareholders. And why has this increased profitability come about? Well, mostly it's come about because we were able to create a more efficient balance sheet. We're able to use the money better in the operations, which meant there was less assets to create the same amount of profit and more profit because we were able to reduce the interest expense quite dramatically. And therefore, we had a good outcome. All right. Let's leave it there. I think that's good enough to see the implications of being able to adjust some numbers and see how it shows up in the performance.